Welcome back to Assets and Taxes. My name is Pete Doherty. I'm a financial consultant here with Asset Strategy. Today, I'm speaking with Nick White from U.S. Energy. We'll be talking about something that's on everyone's mind, energy markets and how the AI boom and tensions in the Middle East are shaping both supply and demand. Nick, welcome. Can you tell us a little bit more about yourself and U.S. Energy?
Yeah, happy to be here, Peter, and thank you for the opportunity. Nick White with U.S. Energy, Director of Business Development. Started here when I was 21 years old. I think that makes me one of a few millennials that stuck with one job out of college. So, been in the business now for 15 years, and working with advisors and clients directly on the macro environment of the energy sector, right? Really educating them on where the investment opportunities are and what's going on in the sector, and then layering in, how our clients utilizing the energy sector for tax mitigation investment opportunities across the board. So hopefully can add a lot of value here and appreciate the opportunity to be here.
You guys have been a fantastic partner, and I always enjoy your insights, so this should be good for our guests, for our listeners. So much going on in the world, but before we get into all the current events, let's take a step back and talk about some of the longer term trends. I know sometimes it's easy to get hyper fixated on headlines, short term impacts, even political beliefs can sneak in there. But when we look at the big picture for oil and gas and energy, what are the factors shaping supply and demand over the next decade?
Yeah, I mean, that's a really good question. And so I'm gonna kind of split it into two. So when you're looking at the oil markets, right, oil follows global supply and demand. Natural gas is a little bit more domestic. And if you look back over the last decade, on average, the demand for oil goes up about 1 million barrels a day every single year. Right. So as of this past year, we as a globe consume 105 million barrels of oil every single day. It's a stark increase from what you saw 30, 40 years ago. And a big reason is that energy demand really does move pretty lockstep with population, global population. Right. So if you take it back 50 years, I think at that time we had about 4 billion people walking and living on this planet. As of last year, I think we surpassed 8.2 billion people. Well, more people means more energy demand. And historically, I usually ask the question, we get so, I would say, siloed into what's happening here in the US, and rightfully so, we live here. But I always ask the question, when you think about the global markets, do people want to live like the United States, or does the United States want to live like other countries? And obviously, it's the latter. And so, how do you continue to develop, right? How do you continue to grow as an economy, as a country? It's access to energy and demand. So, I do think a lot of that growth on the demand side has been attributable to the population side of that equation.
Absolutely. Thinking about raising the standard of living across the globe, I mean, so many countries at this stage are still burning like wood, right? Which is even dirtier than, from a carbon standpoint than oil gas. So I think that's an interesting part too. If you were to describe the energy landscape, the mix of energy, let's say in 2035, what does that look like? What's bigger than people expect? What's smaller? What's gone maybe entirely? To what extent will alternative sources replace oil and gas?
I think that's probably one of the bigger questions I've gotten over the last decade, right? With the advancement of the renewable sector, right? Capital formation and funding going into that. And the big question is how has that impacted the demand side for actual fossil fuels? I may be the only oil and gas company that's going to say, or contact that's going to say this, but I think there's been a misnomer on, energy transition, right? You've heard that a lot, like how we're transitioning more to fossil fuels. But when you pull back the data and actually see what's happening, it's more of an energy addition, right? So if I take you back a decade ago, renewables were really 4% of total energy composition, whereas fossil fuels made up close to 85% of that. We've spent as a globe almost $1 trillion over the last decade in the advancement of wind, solar, renewables. After that $1 trillion of spending in a decade of time, energy consumption for renewables went from 4% to 8%, right? So it's still the smallest sector of actual energy composition. But the fact of the matter is it needs to, and we need to continue funding that side of the house because oil and gas, we can't meet the energy demand needs for the 8.2 billion people on this planet alone. I'm trying to transition that conversation from an either or discussion, right? Either renewables or oil and gas, when ultimately it needs to be an all hands on deck situation. Looking into 2035, if I was a betting man, I think you're going to see even more, all right, advancement into wind and solar. That's not going to cut into the actual amount of barrels of oil that you need on a day-to-day basis as a global population. People are going to continue to live longer as technology advances. I would more than likely guess that you see an uptick in nuclear. I know it's a scary word in that it follows that NIMBY model. Nobody wants one built in their backyards, but
Mm.
the reality is that nuclear is probably the most efficient energy source that we have as a technology, right? So I do think you're going to see advancement of all energy sources in an all hands on deck type of situation.
Makes perfect sense. I mean, if you're when you, I mean, I guess in percentages, do you have a guesstimate from, let's say where oil and gas is today to what it might shift to in a future state with maybe some other supplemental alternatives?
Yeah, I think we're fossil fuels in general are about 80% of total energy composition. I think taking it to 2035, probably similar, right? I would say probably between 75 and 80%. And a lot of it is due to, and I think, if anyone's watched Landman, they do a little bit of a good job about talking about the different actual products of oil and gas. I think a lot of individuals think that oil is just used for gasoline, and it is, right? That's kind of what is attributable to our ability for jet fuel and gasoline. But all the different byproducts of petrochemicals, a lot of people don't understand where that goes. Right? Well, almost every single piece of plastic that you use, almost every single piece of technological equipment that you're using on a day-to-day basis, computer chips, wiring, even most medicines, right? They have petrochemical products within them. And so this isn't something that can just be, okay, we're going to invest in wind and solar, oil and gas is going away. Well, no, with all the different byproducts and how heavily we rely in our day-to-day lives on oil, even for manufacturing, that's always going to be a large part of our day-to-day consumption.
And I think that leads us into our next conversation, which is the current events, supply chains. Where do these various sources come from? How does this all fit together, right? Because oil and gas, as you said, is not just one thing. It's a number of different. The quality of the gas, the characteristics of the oil and gas matters, and those are produced in different places. So it's been a very interesting, year in terms of geopolitics. So to say the least. So maybe you can give us some of U.S. Energy's backdrop on how things are shaking out.
Yeah, so I mean, going back to my first point, right? We understand that the world consumes 105 million barrels every day. Really, where you see pricing swings and movement is on supply side. And so when you see these massive supply disruptions, right? Like when Russia first invaded Ukraine, you saw a supply disruption. What happened to oil prices? They went up. Now, unfortunately, where this current geopolitical issue is happening in the Middle East, that's a major red flag for the supply side of oil globally. Because we're producing right now in the US around 13.7 million barrels a day. And when you factor that into the 105 million demand, we're roughly about 13% of the market, right? So supply movement doesn't really impact us domestically. We're not going to move the needle on pricing. But when you move over to the Middle East, right? And now you're talking about countries like Saudi Arabia, the UAE, Kuwait, Qatar, Iran, roughly 40% of daily oil production consumed comes from those Middle Eastern nations. And what you've seen over the last 2 months is a little old 17-mile long strait, right, width. That little strait, and if you guys haven't heard of this, it's the Strait of Hormuz. Basically, 20% of all exports are coming globally are coming through that strait every single day. That's basically been just shut down, right, for the last 2+ months, where tankers are really being stranded on either side of the aisle, fearful of an attack. Maybe insurance companies aren't, insuring them to go through, but that's really caused a huge disruption to day-to-day life, right? You're talking about 20% of the market just not making it to the end user. which obviously is a big reason why you saw oil at $60 a barrel December of 25 to, I mean, I'm looking at WTI today over $101 a barrel, a big, big jump. Um, and so it's important to note that, when you have these conflicts over in the Middle East, that tends to add a higher level of risk premium to the price because that's where most of that supply on a day-to-day basis comes from.
And I guess in terms of characteristics, when you think about, what's produced in, say, the Permian Basin, how is that different from what gets produced in the Gulf?
Yeah, really good question. And so the US, right? So we're producing all-time highs, right? 13.7 million barrels a day is the most that we've produced. And something that you may have heard, okay, now we're energy independent. All right, well, that's not really the reality. When you pull the onion back, there are different types of crude oil. So we in the United States, we produce what's called a sweet crude. So think of that, a byproduct of, gasoline and jet fuel. But if we were going to make all the other byproducts, asphalt, lubricants, plastics, things like that, you need a heavy crude, right, to be able to blend with your sweet crude, and that's how you're going to get those other byproducts. And so we'll produce 13.7 million barrels of oil every day, but we import still about 8 million barrels a day of heavy crude so that we can blend that. So I do think that what you're seeing right now is going to have an impact in terms of our ability to import, probably spending a little bit more on those imports. Two of our biggest partners are our neighbors in Canada, right? Canada is a big attributor to that 8 million barrels imported every day. Been getting a lot of questions on Venezuela. Venezuela also is a producer of heavy crude, so they will start to impact that, and we're going to be able to collect some of that heavy crude from Venezuela, given everything that's transpired recently.
So, given all the tensions and the disorder in the global markets right now, do you see this getting resolved anytime soon? How do you see that impacting price in the short run, the medium term run? Is there, once this gets resolved, let's say, how quickly can that price adjust downward?
Yeah, I think that's probably the biggest question that I've been receiving here over the last 2 months is, hey, if a ceasefire, if this stops, what is the impact on prices? And what you're seeing is every day that this goes longer is going to have a longer term impact on, pricing. Uh, this isn't something to where, a ceasefire happens today as you and I are talking, right? Which, as Trump said yesterday, that seems to be on life support. But let's just say that we do see a ceasefire today and everything subsides. It's going to take a few years to get back to an equilibrium. You've had 2 years of basically historically low oil production coming from OPEC. I think I read an article yesterday that they're at a 26-year low in terms of actual production making it to market. That's going to have significant long-term impacts on day to day. On top of it, I think you're seeing quite a bit of avenues that are being overseen by individual investors. And that's really what we've tried to do to mitigate the rise in price from this disruption is we've released a ton of oil from strategic oil reserves, right? I think the G7 nations came together and recently said that we were going to release 450 million barrels of oil into the market to try to place a stopgap within the pricing movement. And what really opened my eyes at that time is historically, as I've been working in this industry, when you see news like that, that's going to drop prices pretty significantly because you're seeing a flood of supply coming to the market. But when that was announced, oil prices actually went up 4% that day, right? So you're seeing actual major supply disruptions on the physical market, which aren't going to be just, forgiven as soon as the ceasefire deal happens. On the other side of it, I don't know if we know the extent of the damage just yet. For example, here in the US, we have hurricane seasons, right? And so as hurricanes are going through the Gulf, uh, we have teams that will go out to the Gulf and assess the damage from the hurricanes and those oil and gas platforms. And they'll kind of look at, okay, what's the damage been to this platform? How long is supply going to be disrupted for? How much is it going to cost us to repair this asset? We haven't done any of that in the Middle East yet. Nobody really knows. And so I think that there's this really unknown impact coming down the line as the ceasefire does happen. Teams will go in and they'll assess the damage. The only thing that we do know, Qatar was pretty open about it. Basically, 17% of their LNG plant was destroyed in the conflict. In Qatar, that LNG plant's the number one producing LNG plant in the world. They said it's going to take at least 5 years and over $4 billion of capital to get that back online. And so I think that what you're going to see is more longer term higher prices, higher than normal prices for an extended period of time. And again, I think that that risk premium continues to go up every day that this conflict continues.
Do you think that causes a shift in supply chains? Will this result in more exports coming from the United States? Is that a possibility? And then I guess on the second half of this, I've supply is clearly constrained globally. Some have speculated that the U.S. might kind of depart from the one world price and maybe have pricing of oil for the domestic market, maybe something different from the external market. Do you see any likelihood of that?
I think it's really tough, right? I think that right now we're producing 13.7 million barrels a day at all-time highs. I go back to the last term or the last year under the Biden administration. You know what that number was?
What was it?
13.3, right? So that's a 400,000 barrel increase under the Trump administration, which is obviously, not obviously, but Republican presidents are a little bit more favorable regulatory, which I don't think is a secret to oil and gas companies. And so that's really just been attributable to 400,000 barrels of domestic production coming every day. In order for us to export more oil, I think that you're going to need to see historic levels of CapEx spending going into new wells being drilled here in the United States. And what I've noticed here is that the drilling activity has kind of dropped, right, or hasn't jumped as much as we would have thought. Um, but at the same time, these publicly traded major oil and gas companies stock prices are at all-time highs. So the CapEx spending that I would like to see for us to export more isn't happening. And ultimately, those companies are really just focused on their stock price and their investors, which
And
is working
and
really
so
well.
yeah, so what are some of those? Because I mean, it's a great point. So some of the majors, ConocoPhillips, Exxon, they're a little bit more disciplined, should we say, looking for high return projects and not necessarily investing heavily in new fields. So how is that discipline playing out at the operator level, and what does it mean for smaller or mid-sized players like U.S. Energy?
Yeah, I can actually pinpoint the transition of this to this actually happened during COVID, right? So if you look, I'm going to look pre-COVID and post-COVID when you're looking at these publicly traded massive oil and gas companies. So pre-COVID, how those big firms, Conoco, et cetera, were valued on Wall Street was on their ability to grow their reserves. And so what you saw is these companies in very cheap interest rate environments. We wish we could go back, but 2-3% interest rates, these companies would take on a lot of debt. They would use that to buy assets, drill new wells, and based on prices at that point and low interest rates, they could cover that debt payment and they could just show their reserve values were growing. If you could show your reserves were growing, Wall Street would issue a buy side sticker on your stock and everybody was happy. That all changed, right? Post-COVID. Post-COVID, Wall Street was really looking at these companies on their ability to operate within their own cash flow. And so what have you seen these companies do post-COVID? Most of them are increasing their dividends, right? Issuing stock buybacks and reducing their debt. Um, when they do those three things, that's leaving them a lot less capital to go out and drill new assets. But if you're the CEO of you name it, right, and you're drilling less wells, but your stock price is going up, that's your job, right, is to increase value for your shareholders. So they're not really changing at that time. So there was a massive, I would say, lack of capital spending going on over the last few years from the public side. And that gives a lot of opportunity to the private side, right? So you look at these small, mid-sized players, US Energy being one of them, there's a lot of potential investment opportunities, right? So really what we've done as a firm is we've become more of a non-operated company, right? To where we're actually aggregating capital in and co-investing that capital alongside of these publicly traded majors into their assets, right? So giving investors access to institutional grade acreage positions, higher rates of return, lower risk profiles. And so I think that you're seeing that across the board on the private side to where they're kind of jumping in and kind of carrying the torch per se for this U.S. production with a lot more upside potential for the investment community.
Excellent. I think from an investor perspective as well, what's the difference between, say, investing in a publicly traded stock like Exxon and then finding a deal maybe in the private markets with something like U.S. Energy?
Yeah, and that's a great point. There's a lot of different ways to have exposure to the energy sector, right? You can do equities, you can do MLPs, and then you have this other side of the avenue to where you have direct investments, to where it's an actual hard asset partnership that you're investing in with thousands of other clients. Each have their trade-offs, I would say. Like if you're investing into the equity markets or MLPs, you have a lot more liquidity, right? So those are easily changeable, exchangeable, things like that. That's more focused on, I would say, growth side. Dividends are great, so you can classify that as income side as well. So more income and growth oriented with liquidity. But if you look over at the private side, what a lot of clients don't realize is that the government has all these incentives for investing directly into the oil or gas space. The specific tax code, IRS code 263C, has been a part of the tax code since 1914, right? And so with that, investors that invest, let's say in an oil or a gas drilling fund, can take a tax deduction in the year of investment, right? So if you're a super high W-2 earner, 1099 earner, K1 income, or you have capital gains, the direct energy space can be a really good investment opportunity to reduce your overall tax liability with that deduction and then gain cash flow, right? Hard assets through the production of the wells that are drilled within that portfolio. At the same time, I think you have a couple different hedges, right? So if you're investing directly in the commodity sector, like you actually have individual ownership of these assets based on your division of interest. And so with that, you have like an inflation hedge, right? I just saw the report today. I'm sure you did too. Inflation rose to 3.8%, right? And so when you're investing in the direct side, inflation and direct energy investments are positively correlated, right? So as inflation goes up, the price of oil and gas go up, and investors kind of get a better rate of return. Um, Both make sense, right? I just think it's different parts of the portfolio. Are you focused on liquidity, or are you really looking at these as potential unique tax mitigation strategies with strong cash flow on the private side?
And let's focus on that tax mitigation strategy a little bit more because I think one of the key things here is that there's so many opportunities, or most often you hear about a tax mitigation strategy, and it really addresses the passive side of your portfolio. What's unique about oil and gas is its ability to help offset some of your active income. Can you tell the folks a little bit more about that?
It's one of the best strategies in the space, right? And when you peel the onion back, there's not a ton. You know this. There's not a ton that can really alleviate active income like your W-2 or 1099. Oil and gas is one of those few because again, the government likes to incentivize this for national security reasons and investments. So investors that participate in oil and gas drilling funds, they usually enter in as a general partner. You're usually a general partner for a period of the drilling phase, which can take up to 12 months. But that general partner designation is what allows you to take this deduction against your active income, right? So if you're $1 million earner and you do nothing, you're probably going to owe $300,000, $400,000 in taxes. And now you choose to, invest $100,000 into an oil and gas drilling fund, receive, let's say, a 90% deduction. You're probably saving closer to $40,000 to $50,000 in taxes based on a $100,000 investment. So to me, it's one of the best ways for clients to do tax planning, right? It kind of gives you the similar idea of a charitable donation. But at the same time, you're getting an actual ROI, right? An actual investment return from the production of those assets year in, year out. And so there's so many different ways I've seen clients use this. Offsetting R&Ds, right? Perhaps you're looking to do some Roth conversions this year, using this as a way to help offset the Roth conversion cost through a tax deduction. One thing that I did personally this past year, because I was running into it in New York, after the tax law change, right? You saw a change in the state and local tax deductions. If you make over $500,000, you're really limited to only using $10,000 of that state and local tax. Now, if you can get that lower than 500, now you're able to take it against, I believe it's 30 or 40,000 in state and local deductions. And so, using this is to get your AGI lower to phase in certain benefits. There's just so many really cool different ways that very successful clients are using this type of investment space to create tax planning and also an investment opportunity that gives you strong cash flow.
Absolutely. It's a powerful strategy that we've used for a number of clients, and it has a number of different benefits, right? So the tax benefits, but also the diversification, a different allocation to a really unique sector that has powerful inflation hedges. I mean, if you look at inflation, how much of that is driven off of the price of oil? It's a huge, yeah, right. Just this month's report. You need look no further. Um, so the other, I think, really cool tax mitigation strategy that lots of oil and gas or can use is the opportunity zones. So want to talk a little bit more about that and how that might be positioned.
I think it was probably one of the more transformative tax law changes that we've seen in an extremely long time. So for those that are not familiar with qualified opportunity zones, they came out in 2017 in the Tax Cuts and Jobs Act. And what it allowed, different states to do is their governor was able to designate certain areas within their state that qualify as opportunity zones. And so at that time, you started to see investment companies, real estate, oil and gas, you name it, construct funds that invest that capital solely into these opportunity zone areas, and hence the name Qualified Opportunity Zone funds. But to me, I kind of attribute it to like a super Roth conversion, right? So it really has to be capital gain focused. So if you're somebody that has a capital gain event from any sort, short term or long term, a qualified opportunity zone may make a lot of sense for you, because you can have the ability to invest in a qualified opportunity zone, defer that capital gain, create income right from the underlying investment. And to me, the number one biggest advantage of a qualified opportunity zone is if you hold it for 10 years, if your dollar grows to $2, $3, whatever it may be, in year 10 and you exit, all of that's tax free, right? So you're telling me you're getting an income stream and creating this massive windfall of potential tax-free growth. And that's kind of how I attribute it to like a super Roth conversion, without the income limitations that some may face. Um, Again, it was just made permanent too. I think that's a huge discussion point to where, you're not going to see that as a part of day-to-day planning, going forward, starting in January 2027.
Really cool. Yeah, and there was the 1.0, which was fantastic, and 2.0 looks like it will be just as good, if not better. So we're all looking forward to 2027. All right, so for the last bit, we're going to do a couple of predictions, Nick, and we're all going to hold you to them. So the first one is Hormuz fully reopens by year end 2026. Are you saying yes or no?
Yes, with the caveat of Iran still trying to charge fees to go through it.
Okay, I like that. Well, it's already open, so that's what I've heard in some cases. Um,
Depends on who you ask. Yes,
it's a right. So, oil price end of 2026, over or under $80.
over.
What's the most underappreciated energy investment theme right now?
The most underappreciated energy investment theme right now. It's been getting a lot of news, but I do think that the data center investment isn't getting enough appreciation, right? It's hotbed topic in AI, but everyone's talking about AI. Nobody's talking about what it takes to actually power AI. So I do think that you should hopefully continue to see investment in data centers. Specifically, we're seeing it in the Permian Basin and in the Northeast with natural gas focused investments. Um, so that would be my answer. More actual manufacturing and building data centers.
All right, Nick, it was great talking with you. It was incredible insights. I've learned a lot. Hopefully, our audience has too. If you'd like to learn more, go to our website and download our oil and gas guide. You can also click directly in the description of this video. And if you want to talk to us directly, book a 15-minute call with our team using the link below as well. Thanks for joining.